The secret crisis beneath a booming market. On the surface, everything looked perfect. Markets were rising. Headlines spoke of resilience. Charts pointed upward with reassuring confidence. But beneath that calm exterior, a quiet crisis was already tightening its grip, unseen, unspoken, and dangerously close to breaking through. This story matters now because the most dangerous failures don't arrive during crashes. They arrive during booms. When optimism is highest, vigilance is lowest. And while investors celebrate growth, hidden pressures can accumulate deep inside the system. To understand how prosperity can mask instability, we need to revisit the moment when a thriving market concealed a crisis no one wanted to acknowledge. It began during a period of record highs. Corporate earnings looked strong. Consumer spending held firm. Volatility hovered near historic lows. Commentators declared the system healthy, flexible, and prepared for anything. Capital flowed freely. Risk felt distant. Comfort became the dominant emotion. But in the background, subtle distortions were forming. Debt levels crept higher, not just for governments, but for corporations and households alike. Cheap money encouraged leverage. Refinancing replaced repayment. Each cycle pushed obligations further into the future, quietly increasing dependence on low rates and constant liquidity. The early reveals surfaced in places few people watched. Credit spreads stopped narrowing. Covenant standards weakened. Lenders competed aggressively, sacrificing caution for yield. Balance sheets expanded faster than cash flows. These were not alarms, just faint signals buried beneath celebration. Large institutions noticed first. Risk teams flagged anomalies. Stress tests showed vulnerabilities that only appeared under extreme scenarios. But the scenarios felt implausible. The market was booming. Confidence was strong. And in times like these, warnings sound like pessimism. So they were ignored. Meanwhile, shadow markets grew. Off-balance sheet financing expanded. Derivatives layered risk upon risk, obscuring exposure behind complexity. Each innovation promised efficiency, but together they created a web so dense that even experts struggled to trace its threads. The boom continued. Prices climbed. Wealth grew. And with every new high, belief in stability hardened. Yet beneath the applause, the system was quietly absorbing strain. The secret crisis wasn't waiting to arrive. It was already there. As the boom accelerated, the pressure beneath it intensified. Corporations took advantage of easy credit, issuing debt at a pace that outstripped real growth. Buybacks replaced investment. Short-term gains overshadowed long-term resilience. On paper, balance sheets looked efficient. In reality, they were becoming fragile. The reveal deepened when lenders quietly adjusted their behavior. Loan maturities shortened. Fees increased. Collateral requirements tightened in subtle ways that rarely made headlines. These weren't signs of panic. They were signs of caution creeping in where confidence once ruled. But the broader market barely noticed. Equity prices kept climbing. Optimism drowned out nuance. Behind the scenes, risk migrated. It didn't disappear, it shifted from regulated banks to less visible corners of the financial system. Private credit funds expanded rapidly. Shadow lenders filled gaps left by traditional institutions. Their terms were looser, their oversight lighter, their appetite for risk far greater. Money flowed freely, but accountability thinned. The early conflict emerged when a handful of leveraged players began struggling to roll over debt. Not failing, just straining. Refinancing took longer. Costs edged higher. Cash cushions shrank. These were isolated cases, easily dismissed. After all, the market was booming. One weak link didn't matter in a system this strong. But weak links rarely stay isolated. Stress tests inside major institutions began flashing amber. Models showed that a modest shock, not a crash, not a crisis, could cascade through interconnected obligations. Liquidity assumptions failed. Correlation spiked. The system's strength relied on one fragile condition: uninterrupted confidence. Still, outward calm prevailed. Investors chased returns. Media celebrated resilience. Policymakers pointed to growth as proof of success. The contradiction grew sharper by the day. Stability on the surface, vulnerability underneath. And in that contradiction, the secret crisis continued to grow, fed not by fear, but by belief. Belief that the boom could not break. The ship began with something so ordinary it barely registered. A mid-sized firm missed an earnings target. Not dramatically, not catastrophically, just enough to disappoint. In a normal market, the reaction would have been brief. A dip, a shrug, a move on. But this time, the response lingered. Credit spreads widened around the firm. Lenders reassessed exposure. Analysts adjusted forecasts, not just for one company, but for its entire sector. The move was subtle, but it cracked the illusion that everything was aligned. For the first time, doubt slipped through the surface of the boom. The conflict deepened when a private credit fund quietly suspended redemptions. The announcement wasn't publicized. It appeared in a filing few people read. But inside financial circles, the message landed hard. Liquidity, assumed to be abundant, wasn't guaranteed. Assets that looked stable on paper couldn't be sold without impact. Institutions reacted cautiously. They didn't panic. They adjusted. Positions were trimmed. Exposure was reduced. Risk committees met more frequently. Each decision was rational on its own, but together they created friction across the system. Transactions slowed. Funding costs edged higher. The machinery of the boom began to grind instead of glide. Then correlations started to behave strangely. Assets that should have moved independently began drifting together. A small shock in one corner of the market echoed elsewhere. Hedging lost precision. Diversification weakened. Models built on calm conditions produced unreliable signals. Traders sensed it before headlines did. The market felt heavier. Breakouts failed. Rallies stalled. Selling pressure appeared without obvious catalysts. Nothing was breaking, but nothing felt solid either. The boom was still visible, but its foundation had softened. As tension built, leverage became a liability instead of an advantage. Positions that relied on smooth liquidity suddenly required constant attention. Margin requirements crept upward. Refinancing windows narrowed. What once felt effortless now demanded vigilance. And in that slow tightening, the secret crisis moved closer to the surface, not through collapse, but through accumulation. The system wasn't waiting for a disaster. It was becoming one. The climax arrived not with crash, but with a realization that spread quietly through the institutions that mattered most. The boom wasn't protecting the system. It was masking its weakness. And the longer it continued, the more dangerous that weakness became. The moment of truth came when a routine liquidity test failed. A large institution attempted to unwind a position it had always considered safe. The order didn't fill. Not quickly. Not cleanly. The market hesitated. Prices slipped. Dealers stepped back. What should have been effortless suddenly wasn't. And in that hesitation, the illusion cracked. Behind closed doors, risk managers compared notes and reached the same conclusion. Too many positions depended on constant optimism. Too many balance sheets relied on uninterrupted growth. The system could survive a shock, but only if that shock never arrived. And history had never been so kind. The resolution unfolded through quiet adjustments rather than dramatic action. Exposure was reduced. Leverage was trimmed. Capital buffers were rebuilt. Policymakers issued carefully worded statements aimed at cooling excess without triggering fear. The boom continued, but at a slower, more cautious pace, as if the market itself had sensed a danger and stepped back from the edge. For the public, nothing seemed wrong. Indices remained elevated. Headlines stayed positive. But those who had seen beneath the surface understood what had happened. The crisis had not exploded, but it had been acknowledged, diffused for now. Modern relevance is impossible to ignore. The most dangerous moments in finance are not when everyone is afraid. They are when everyone feels safe, when growth feels permanent, when risk feels distant, because that is when systems stretch farthest and break most violently if pushed one step too far. The secret crisis beneath the booming market didn't end with a collapse. It ended with a warning. Sometimes the smallest shift in perspective becomes the beginning of a new future. The secret